In the previous class, we have completed the recurring documents. After that, we have to start foreign currency postings. So today I have taken the new connection, right? So from today onwards, you don't have any problem regarding the internet issues, right? I hope so. Just a half an hour back only, right? The foreign currency postings. Here, the financial statements of the company code are to be prepared in the company code local currency only. Here, our company code local currency is INR, right? So we have to prepare the financial statements in Indian rupees only. So, but it is quite natural that every company code will incur the business transactions in number of foreign currencies. So in that case, these business transactions are also posted in the foreign currencies only. But for the purpose of preparation of financial statements, these foreign currency transactions are to be converted into local currency. So in that case, the amount of the foreign currency business transactions are to be converted into company called local currency. So we can configure the system to convert the foreign currency business transactions into company called local currency at any of the following exchange rate types. Say, for example, you are incurring the business transactions in US dollars, GBP, Great Britain pound, and Singapore dollars, etc. Let us take the case of US dollar. So when you incur the business transactions in the US dollar, they are to be converted into company called local currency. For that purpose, these foreign currency business transactions can be converted either at the bank buying rate or at the bank selling rate or at the bank average rate. So this bank buying rate is represented with the letter G, bank selling rate is represented with the letter B, and the bank average rate is represented with M. So GBM, bank buying rate, bank selling rate, and bank average rate, they are called exchange rate types. So what is bank buying rate? It is the rate at which the bank will purchase any foreign currency. Bank buying rate means the rate at which the bank will purchase any foreign currency. Say, for example, we have exported some goods to USA customer. You have sold some goods to USA customer. And the USA customer has made his payment in US dollars. So you cannot use the US dollars as such in Indian market. And also you don't have any dollar accounts where you can deposit these dollars. So you have to convert them into Indian rupees. For that purpose, we approach the bankers. See, the bankers are considered as very much reliable sources as far as the financial transactions are concerned, right? So we approach the bankers, and the bankers will purchase the dollar at a specific rate. That is called bank buying rate. Then you have the bank selling rate. It is the rate at which the bank will sell any foreign currency. For example, you have imported some plant and machinery from the USA vendor. So you have to make for $1 lakh. So you have to make the payment in dollars only. And you don't have any dollar reserves. So you purchase the dollar to so you purchase the dollars from the so you have to purchase the dollars and you approach the bankers. And the bankers will sell the dollar at a specific rate. That is called bank selling rate. Then bank average rate. It is the average of bank buying rate and bank selling rate. It's not average, right? Please rectify this. Just a minute. Yeah. So in the place of average, you have to write selling rate. So it is the average of bank buying rate and bank selling rate. So here, this GBM are already defined the system. So according to client requirement, See, everybody is able to see my screen.
Yes, sir.
So
Yes,
Santosh,
sir.
check your internet because others are able to see my screen, right? So for you, it has disappeared means maybe internet problem for your side. So this, according to client requirement, you can configure the system to convert the foreign currency transactions either at the bank buying rate or bank selling rate or bank average rate. And this GBM are already defined in the system. You can use this exchange rate types or you can define your own exchange rate types also, right? See, first you have to verify whether these exchange rate types are different in the system or not. Yeah, okay, Santosh. So to verify the foreign exchange rate types. SPRO, SAP NetWeaver, general settings, currencies, check exchange rate types. Now see the material. No action required. Just to verify whether following exchange rate types are available or not, right? So click on position. Exchange rate type is equal to G. Click on enter. See, G is already available there. Standard translation at bank buying rate. Then click on position. Exchange rate type is equal to B. Click on enter. See, B is also available there. Standard translation at bank selling rate. Exchange rate type is equal to, click on position. Exchange rate type is equal to M. Click on enter. See, M is also already there. Standard translation at bank average rate. Suppose. So actually you need not define anything. Suppose I want to define my own exchange rate types, right? In that case, click on new entries. You can go up to 4 characters, right? For example, exchange rate type X, bank buying rate, Y, bank selling rate, Z, bank average rate. Otherwise, PQR or any identification. You can define your own exchange rate types also. So actually, you need not do anything, right? Yeah. Click on save. Now, write down the table name. TCURV. So exchange rate types table name TCURV. Next. Define translation ratios for currency translation. Means translation ratio means it is the relation between the minimum units of two currencies in the commercial usage for the conversion purpose. For any pair of currency, the translation ratio is always 1:1. But for the Japanese yen, the relation is always 1:100. That means it is the relation between the minimum units of two currencies. Say, for example, our company called local currency is INR, right? So INR is to USD is equal to 1:1. Then INR is to GBP is equal to 1:1. Then INR is to Singapore dollar is equal to 1:1. This is called translation ratio. Here, INR is to USD is 1:1 means singular units of $1. Singular units of dollars is to be converted into singular units of Indian rupees. INR is to GBP is equal to 1:1 means singular units of GBP is to be converted into singular units of Indian rupees. Singular units of Singapore dollar is to be converted into singular units of Indian rupees. This is called translation ratio. So it is the international standard. For any pair of currency, it is always 1:100, but only for Japanese yen, right? JPY. is equal to 1:100. Means 100 yens will be taken as 1 unit. 100 yens will be taken as 1 unit for the purpose of conversion. So this relation we have to define. Path is same as above. Define translation ratios for currency translation. Click yes on the message. Click on new entries. Exchange rate type is equal to G. Exchange rate type is equal to G. From is equal to USD. Means from currency is equal to USD to INR. So we have to convert into Indian rupees, company code local currency. Valid from 19/10/2024. Ratio from 1, ratio to 1. Exchange rate type is equal to B. From is equal to USD to INR. Valid from 19/10/2024. Ratio from 1, ratio to 1. Exchange rate type is equal to B. From is equal to USD to INR. Sorry, exchange rate type M. Bank average rate, no? Exchange rate type is equal to M. From is equal to USD to INR. Valid from 19/10/2024. Ratio from 1, ratio to 1. Click on save. Write one point there. Here some space is there, right? Write down. We have to define the translation ratios. We have to define the translation ratios for each foreign currency. For each foreign currency with reference to company code local currency. With reference to company code local currency. For each exchange rate type. For each exchange rate type. Means, for example, we are also incurring the business transactions in GBP, right? So for GBP also, we have to define the translation ratio for every exchange rate type. But like this, exchange rate type is equal to G, from is equal to USD to INR, valid from 19/10/2024, from ratio 1 to ratio 1. Exchange rate type is equal to B, from is equal to USD to INR, valid from 19/10/2024, from ratio 1 to ratio 1. Exchange rate type M, from is equal to USD to INR, sorry, it's not USD, GBP. I'm sorry. From is GBP, right? To INR, valid from 19/10/2024, from ratio 1 to ratio 1. Again, you are incurring the business transaction in Singapore dollars. So for Singapore dollars also, you have to define the translation ratio. If you are incurring the business transactions in 10 foreign currencies, 10 into 3, 30 relations are to be defined here. Clear for everybody?
Yes, sir.
Yes, sir.
Concept.
So it's just a one-time activity, or do we need to do it on
It's a one-time activity,
Okay.
right? See, configuration settings are always one-time activity.
So can you help me with that explanation? The 1:1, right? So 1 unit of this thing. So can you help me with an example, sir?
See, okay.
Yeah.
First, write down the table name.
Sure, sir.
TCURF. Translation ratios table name is TCURF. means here translation ratio INR is to USD is equal to 1:1 means $1 is equal to how many number of rupees? 85, 86, 87, right?
Yes, sir.
That is called single unit of dollar is to be converted into singular units of INRs.
So, okay, as per the system requirement, we have to give 1:1. But if you would have just given the INR to USD, then also it
Then
would be this.
1:1.
Oh, okay, okay.
See, relation is always same.
Mm-hmm.
Yeah.
Only in case of Japanese, it is 1:100, sir, right?
1:100.
But
Suppose
in yeah.
2000 yens.
Mm-hmm.
That means 20 units of yens
Mm-hmm.
is equal to how many number of rupees? Clear?
Yes, sir.
Yeah. Now, enter exchange rates. So this is end user activity. For the first time, right, at the time of implementation, consultant will enter the exchange rates. But after that, every day the user has to enter the exchange rates. How they are entered, I will explain you.
So the date which we have given as valid from is that will remain the same, sir, or how it is, sir?
Which one?
The to and valid from is there, right? Just beside ratio from.
Yeah, valid from is the one-time activity. Here, you have entered valid from 19/10/2024. So till you enter the new ratios, this is valid.
Okay. And as you said,
Not enter valid to, you enter valid from.
Okay.
Right?
Yeah, and as you said, the ratios will not change, right? It will remain the
Yes,
same.
obviously.
Okay.
Obviously.
Okay. Yes.
So enter exchange rates. Path is same as above. Enter exchange rates. Click on new entries. Exchange rate type is equal to G. Valid from 19/10/2024. From is equal to, from means from currency is what? US dollar. Direct quotation 85. I will tell you what is this. To IN. Exchange rate type is equal to B. Valid from 19/10/2024. From currency US dollar. B means bank selling rate, right? Direct quotation 87 to INR. Exchange rate type is equal to M, means average rate. Valid from 19/10/2024. From is equal to USD to, direct quotation 86. 85 plus 87 divided by 2, 86 to INR. Click on save. Write down the table name. TCURR. Now, write some points there. Exchange rate types. Exchange rate types. Exchange rate types. Translation ratios. Exchange rate types. Translation ratios. And the exchange rates are defined at client level. So that they can be used by all the company codes of the client. That means in any company code, right? US dollar rate is 85 rupees. In any company code, US dollar selling rate is 87 rupees. Clear? And for any company code, translation ratio is 1:1. For any company code, these exchange rate types are same. Right. The translation ratios and the exchange rates are defined with validity from date. So, till we define the new ratios and new rates, these are applicable. Next, again, note. In your practice, this is for your practice purpose only. In your practice, at the time of defining the translation ratios, and entering the exchange rates, if the system gives the error message, like an entry already exists with the same key, leave that step. Why so? Say, for example, immediately after the class, right, you are doing the practice for foreign currency transactions, right? In that case, you also enter the same thing, valid from date to day only, right? GBM and same rates. Then the system will give the error message and entry already exists the same key. Why? Because these rates are different at the client. Similarly, in the case of translation ratios also. Clear for everybody?
Yes, sir.
Now, here we have two types of quotations you can enter. Indirect quotation and direct quotation, right? So what is this indirect quotation, direct quotation? Foreign exchange quotations. There are two types of quotations which we can enter in the foreign currency tables. Number one, direct quotation. Direct quotation means per 1 unit of foreign currency, how many number of units of company code local currency we get. It is convenient to use the direct quotation when the foreign currency is bigger than company code local currency, within brackets. That is, it is convenient to use direct quotation. That is, it is convenient to use direct quotation when the from currency is bigger than two currency. When the from currency is bigger than two currency. So it is easy to understand. See here, what is from currency? US dollar. Two currency, INR, right? So from currency is bigger, right? So it is convenient to use direct quotation. Technically speaking, you can enter either direct quotation or indirect quotation, but it's only a matter of convenience to use either direct quotation or indirect quotation. Then coming to indirect quotation. See, direct quotation. for 1 unit of foreign currency. That means for $1, how many number of rupees you get? 85, 86, 87. That is the direct quotation. Then indirect quotation. For inverse, for 1 unit of company called local currency, how many number of units of foreign currency? Means in our example, for 1 rupee, how many dollars you get? 1 by 85, 1 by 86, 1 by 87, right? Which will be coming into decimal values. It is convenient to use the indirect quotation when the company called local currency is bigger than foreign currency. That is within brackets. That is, it is convenient to use indirect quotation. It is convenient to use indirect quotation when the two currency is bigger than foreign currency. Sorry, when the two currency is bigger than from currency. Okay. So here, from currency is bigger than two currency, right? That's why I have used direct quotation. Then you have to understand one more terminology, transaction currency. It is the currency in which the business transaction occurs. It is also called document currency. So for every foreign currency posting, the system stores two figures, one in the document currency and other in the company called local currency. So after posting the foreign currency transaction, I will show you both the figures, right? Just give me 1 minute. I'll be back in 1 minute. Yes, I am back. Yeah, Ahmad.
Hi, sir. So you defined direct quotation for buying, selling, and average. So we have three different rates. So are these rates going to be fixed for each month? And then do we need to like change it after 1 month? Because obviously the rates would change, right?
Yeah, not 1 month, every day, right? The price, the rates will change, na?
So do we have to manually change them?
Yeah, every day you have to change. You have to enter the new rates. So how to enter the new rates, I'll explain you. That's not yet covered.
Okay. Okay.
So let us post on foreign currency transaction. Let us see how that is converted. Transaction code F-02. Let us assume that you paid rent in US dollar. Document date is 19/10/2024. Type is SCA. Company code SS27. Posting date 19/10/2024. Period 7. October means 7th period. Currency USD. Within brackets, transaction currency. So the transaction currency means the currency in which the business transactions incurred are posted. Other things are as usual. Posting key 40. Account is 400, 300. Click on enter. See, against the amount, system has taken USD. So amount is equal to 1000 USD. Amount is equal to 1000 USD. Business area SS27. Text being rent paid. Text being rent paid. Posting key 50. Account is 2,100,000. Click on enter. Amount is as this. Business area SS27. Text please. Click on save. See, document 16 was posted in the company code SS27. Now, go to menu document, click on display. Let us display this document. Go to menu document, display. See, rent account data to cash. Rent account data to cash, right? See, $1,000. This is called transaction currency. Now this $1,000 should have been converted into company code local currency. So how to display amount in the company code local currency? Click on display currency. Click on display currency. See, 85 rupees. 85,000. $1,000 is equal to 85,000. 85 means bank buying rate, right? So the system has taken bank buying rate for the purpose of conversion. So why the system has taken bank buying rate? Why not bank selling rate and why not bank average rate? See, I have given one important note. Whether a particular document should be posted at exchange rate type, GBM value is decided by its document type. SA means GL document. KR means vendor invoice. DR means customer invoice. So we have to decide and assign the default exchange rate type to the document type in OBS 7. So procedure to assign the default exchange rate type to the document type, OBS 7. See, let us go to OBS 7. Click on position. Document type is equal to SCA. Click on enter. Select SA document type. Click on details button. See, default values. Exchange rate type for foreign currency documents, G is assigned defaultly. That's why system has taken G rate, bank buying rate. But my requirement is to convert every foreign currency transaction into company code local currency at bank selling rate, right? In that case, you can remove G, you enter B, bank selling rate. Click on sell. So from now onwards, when you post any foreign currency transaction, the system will convert it into company code local currency at a bank selling rate. Let us post one more transaction. Look at the screen. Remember, whatever the transaction you post from now onwards will be converted at the bank selling rate. And the previously posted transactions will not be affected. So let us post one transaction again in the foreign currency. Document date is 19/10/2024. Type is SCA. Company code SS27. Posting date 19/10/2024. Period 7. Currency USD. Posting key 40. Account is 4,100,000. Salaries. Click on enter. Amount is $1,000. Business area SS27. Text being salaries paid. Posting key 50. Account is 2,100,000. Click on enter. Amount is assessed. Business area SS27. Text plus. Click on save. Go to menu document display. See, salary is accounted to cash $1,000. Click on display currency. 87,000 rupees. So that's how, right? According to client requirement, you can assign the exchange rate type in the document type. But there are some normal standards, right? Right now. Normally, the GL transactions, that is document type SCA. That is document type SCA. Will be converted at bank average rate. The vendor invoices, document type KR, are converted at the bank selling rate. Next, customer invoices. That is document type DR. Are converted at the bank buying rate. So these are the standards, but ultimately client requirement is important, right? So based on the client requirement only, we have to assign the required exchange rate type in the document type. Okay. Now, see, we have posted 2 foreign currency transactions, right? Now let us display the line items in cash account, FBL clear. See, the line items are displayed in company code local currency. How? See, we have defined cash account, right? FS00. In the cash account, we have selected only balances in local currency. So when you post the foreign currency transactions, the system will convert that foreign currency transaction into company code local currency when you select this only balances in local currency. Right? Now, so here we have entered the rates from SPRO, right? SPRO, SAP NetWeaver, general settings, currencies, check exchange rate types. So you entered this exchange rates from the SPRO, right? SPRO means it is the consultant stream. So every day consultant will enter the rates? No. Remember, every day we have to enter the rates because every day the rates will change, right? For that matter, every second they may change, but it's not necessary to enter the rates every second. Okay. It is enough to enter the rates every day, right? So, write down. The foreign exchange rate, next note, the foreign exchange rates, the foreign exchange rates are entered by the user daily, in the following path. In the following path. Accounting. Accounting means SAP is the access, right? So SAP is the access always used by end users only. Accounting, financial accounting, general ledger, environment, current settings, enter translation rates. S underscore BCE underscore 68000 174. 68000 174. See, if you click on this same screen, okay. Now, there are many other, not many, there are other methods also to enter the exchange rates, right? Go back to notes, please. Put heading. Foreign currency transactions. Not like that. Heading is conversion of foreign currency transactions. Conversion of foreign currency transactions. We can, the user can enter the exchange rates. The user can enter the exchange rates every day in the following ways. Number one, if the number of transactions, if the number of currencies, in which we are incurring the business transactions are very less in number, the users can enter the rates, in S underscore BCE underscore 68000 174. 68000 174. Next, number two, if the number of foreign currencies are relatively large in the number, or relatively large in number. The user can prepare one Excel sheet. The user can prepare one Excel sheet in the same order of the fields, in the same order of the fields, in the T code, S underscore BC underscore 6800174. 6700174. Full stop. That Excel sheet can be uploaded into SAP system, in the transaction code TBX. Just a minute. I'm sorry. TBX. Forgot the transaction code. Okay, I will tell you the transaction code tomorrow, right? I forgot. TBX. TBX. Yeah, TBX4. No. Just a bit. Not. No. Last number I forgot. TBX is the common. Last digit I forgot. Okay, I will tell you tomorrow, right? Where we can upload the Excel sheet. See here, the user will prepare one Excel sheet, right? In the same order, right? Of this screen. Then that can be stored on the desktop or anywhere you want. From there, in the TBX transaction code, right? It can be uploaded into SAP. Next, number 3. This transaction I will tell you tomorrow. Next, number 3. If the number of foreign currencies are very large in the number, very large in number, very large in number, then the client pays the subscription to the internet sites like like www.xe.com, www.xe.com, www.moneycontrol.com, www.bloomberg.com, etc. We can import the rates from these sites. We can import the rates from these sites. Through the transaction code, TBD4. See, these are some of the internet sites which deals with the foreign currency rates, right? So these sites will charge the subscription for each pair of currency, right? They will offer, normally these sites will offer quarterly, half yearly, yearly, and lifelong subscriptions, right? So they may pay any of these subscriptions. Then through the transaction code TBD4, you can see request current market data. So through TBD4, you can import not only exchange rates, you can import other rates also. Security shares rates also we can import. Interest rates, index rates, whatever the things that are necessary, we can import, right? So these are the three methods. So second point, I told you Excel sheet, right? Now I got the transaction. TBEX, transaction code TBEX. In the TBEX, right, you can enter the Excel sheet. See, market data transfer from spreadsheet. So these are the different ways where we can enter the exchange rates, right? Now, interest calculations. This we will see after 10 minutes break, right? Anyhow, right? One topic is over now. Let us see this after 10 minutes break. So I'll be back in 10 minutes. Yes, I'm back. Ahmad, am I audible? Arafat, am I audible? Or anybody else?
Yes,
Yes,
sir.
sir.
Yes, sir.
Yes,
Okay.
sir.
Okay.
Yeah.
See, interest calculations. So what is this interest calculations, right? See, first I will explain you the functionality and necessity for the interest calculation configuration, right? Say, for example, we have taken one term loan, right? And tenure is 10 years. Right? So when you take the term loan, you have to repay it, right? So you have every month, the installment is to be repaid every month, right? So installment is every month. Now, say for example, you have taken 10 crores, right? 10 years, and installment is 12.5 lakh every month. Installment is 12.5 lakh every month. Now, when you pay this installment, right? This installment amount contains two parts. Some amount towards interest, right? Then some amount principal amount. Yes or no?
Yes, sir.
Others, suppose you have taken one housing loan, right? And you are repaying the housing loan in the form of installment, right? So that installment, out of that installment, some amount is reduced by the bank towards the interest, and remaining amount is reduced from your principal amount of the housing loan, right? Yes or no?
Yes, sir.
Yes, sir.
Yes.
Similar is the case in the case of term loan, right? So out of this 12.5 lakh installment, this interest portion is to be separated, and that interest is to be charged to profit and loss account. And the remaining amount only is to be reduced towards the principal amount. That's why before paying this installment, we have to calculate interest on the outstanding balance of the term loan, and that interest is to be debited to interest account, and it is to be credited to term loan account. So this entry you have to post. Say, for example, you have taken 50 term loans. It's quite common that the big companies will take the number of term loans, right? Suppose if you take Adani in India, he is doing the business with bank loans only, right? Okay. So when you take that 50 term loans, and all these 50 term loans are to be repaid in the form of installments, right? Then every term loan will have the separate rate of interest. In that case, before paying the installments of these 50 term loans, the user has to calculate the interest on the outstanding balance of the 50 term loans, and he has to post respective accounting entries like interest accounted to first term loan, interest accounted to second term loan, interest accounted to third term loan, interest accounted to 50th term loan, and so on. Means he has to post 50 accounting entries. But on each term loan, the rate of interest is different, right? In that case, calculating interest on all the 50 term loans and also posting accounting entries on all 50 term loans, it takes a lot of time. It consumes a lot of time, right? That's why SAP has given some configuration settings. The FI consultant will configure these settings in the client company, right? And the user who is responsible to calculate and post the interest, he executes one transaction code. In that transaction code, he enters the information in 7 to 8 fields. That's it. Then the system will calculate interest on all the 50 term loans, and 50 accounting entries are posted. That is the functionality of interest calculation, right? So in SAP, there are 3 types of interest calculation types. Interest calculation type means the purpose for which interest is calculated. That is called interest calculation type. Number 1, balance interest calculation. It is represented with the letter S in the system. Sorry. Then item interest calculation. This item interest calculation is represented with the letter P in the system. Then penalty interest calculation. This is represented with the letter Z. Here, this balance interest calculation is used to calculate interest on GL account balances. GL account balances means term loans, working capital loans, or OD accounts, debentures, etc., etc. Then, this item interest calculation is used to calculate interest on vendor account and customer account balances. So, what is the necessity to calculate interest on customer account and vendor account balances? Say, for example, we have one vendor X, right? So, from this vendor, we purchased the materials. So, we purchased the materials from this vendor. Say, for example, on 19/10/2024, we purchased the material from this vendor. Invoice amount is 1 lakh rupees. Just a minute. So, sorry, it is credit, no? Vendor invoice credit, right? So, by purchases, see, 19/10/2024, by purchases or by raw material, 1 lakh, right? So, vendor said, right, we have to make the payment on 30th day. He has given 30 days credit, right? Then, and also he said, if we make the payment after 30 days, we have to pay interest of 2%, right? Okay, we could not pay this amount in 30 days. So you paid on 60th day. So for 1 month, you have paid, you have to calculate interest 2%, right? So along with interest, you have paid it, right? 19/12/2024. You paid 2 back. Along with interest, you have paid, please remember, right? Now, if you balance this account, vendor account credit balance is 1 lakh, debit balance is 2 lakhs, 1,02,000, right? So if you balance this, there is a debit balance of 2,000 rupees in the vendor X. Vendor account is a personal account. So in the personal account, debit balance means we have to receive, right? So according to accounts, right, it shows that you have to receive 2,000 from the vendor. Is it really true that you have to receive 2,000 from the vendor? No. So why you have paid this extra 2,000 rupees to vendor? Towards interest, right? So before making the payment to vendor, you have to calculate interest on this 1 lakh. Then we post the entry, debit interest account, 2,000, credit vendor account, 2,000, right? So by virtue of this entry, this is posted to credit side of the vendor by interest. So it is tallied. So in order to calculate interest on vendor account, right, we use the interest calculation type P. That is interest item interest calculation. Similarly, in the case of customer accounts, sometimes the customer, we delay the payment. Then we charge interest from the customer by posting the entry, debit customer account, credit interest account. Interest from the customer is the revenue, right? So whether to calculate interest on the vendor account balances or customer account balances, right? We use the item interest calculation. Then penalty interest calculation. So this penalty interest calculation is used to calculate penalty interest. Normally, this penalty interest calculation is used to impose the penalty on the interest payable to bank. That means every company will take working capital loans. So on the working capital loan, you have to pay interest to the bank on the amount of the working capital you have used as on the last day of every month. Say, for example, 31st October. On 31st October, you have to pay interest to the bank on the amount of the working capital used during the month of October. It has to be deposited to the bank by 31st October. But due to some reason, you have delayed the interest payment to bank for 10 days. So for these 10 days, right, the bankers, according to their policy, they charge some extra 1% or 1.5% on the amount due towards the interest on working capital. This is called penalty interest. So in our books of accounts also, you have to calculate penalty interest and it has to be accounted. So this balance interest calculation and account balance interest calculation and item interest calculation, right, are used by the manufacturer, by the business concerns, right? But this penalty interest calculation is used by the banks. So here I am going to show you, we are in the general ledger accounting, right? So I am going to show you how to calculate interest on term loan accounts. So all this explanation, what is the purpose of balance interest calculation, item interest calculation, and penalty interest calculation, I have given them here. Then see the configuration. Define interest calculation types. So first of all, you have to specify or define which type of interest calculation type you are going to configure. So path is SPRO. Finance accounting new. General ledger accounting new. Business transactions. Bank account interest calculation. Interest calculation global settings. Define interest calculation types. Click on new entries. Just a minute. Okay. Click on new entries. Interest indicator is equal to ST. You can do any name, just like they have given ST. Interest indicator is equal to ST. Name is equal to 12% interest indicator for SS27. Name is equal to 12% interest indicator for SS27. Interest calculation type. Look at the screen. If you press on F4, right, you can see three types of interest calculation. P, item interest calculation. S, balance interest calculation. Z, penalty interest calculation. So compulsory we should select S only because we are in the general ledger. Click on save. Write down the table name T056. T056. So what is this interest indicator? Interest indicator. This is the identification for which we assign all the values necessary for calculating the interest. See, in order to calculate interest, we require different values. Like what? Number one, rate of interest, right? Number two, frequency. Whether the interest is to be calculated every month or every quarter or every 2 months, that is called frequency, right? Number three, number of days to be considered. In a month, right? So these are the different values. These are the sum of the values what we require to calculate interest, right? Now, all these values are assigned to one identification. That identification is called interest indicator. Later on, the interest indicator is assigned in the term loan account master record to enable the system to calculate the interest according to the values defined specified in it, right? Continue one more point. The interest indicator is defined at the interest indicators, plural. The interest indicators are defined at client level. The interest indicators are defined at client level. Just give me 1 second. I'm sorry. Just 1 minute. I'm sorry. I will be back in 1 minute. Yes, sir. Right now, the interest indicators are defined at client level. The interest indicators are defined at client level so that they can be used by all the company codes all the company codes of the client. One interest indicator can be assigned in multiple GL accounts, in multiple term loan accounts, where the rate of interest is same. Where the rate of interest is same. Okay, next. Prepare account balance interest calculation. So while doing the step, I will explain again. Path is same as above. Prepare account balance interest calculation. Click on new entries. Interest calculation indicator, ST. This is what you have defined in the previous step, right? So interest indicator is equal to ST. Interest calculation frequency. So how frequently you have to calculate interest? If you press F4, we can see 12 options. If the interest is to be calculated every month, we enter 01. If the interest is to be calculated every 2 months, we enter 02. If the interest is to be calculated every 3 months, we enter 03. So how do you decide what is the frequency of interest to be calculated? It depends upon, it is contained in the term loan agreement. Means if the installment is to be paid every month, we calculate and post the interest every month. If the installment is to be paid every 2 months, interest is to be calculated and posted every 2 months. If the installment is to be paid every 3 months, it's a quarterly installment, right? Then it has to be posted and calculated every 3 months. So the repayment schedule of the installment is contained in the term loan agreement. So based on the term loan agreement only, right, we enter the interest calculation frequency. Just like that, I'm entering 01. Then calendar type is equal to G. Calendar type is equal to G. Within brackets, Gregorian calendar. Within brackets, Gregorian calendar. Then I will explain you what is this calendar type. Select balance plus interest. Select balance plus interest. Right down there. By selecting this checkbox, the system will display a separate line in the interest calculation. The system will display a separate line in the interest calculation showing the total amount of the loan outstanding, including interest. The total amount of the loan outstanding, including interest. Means, see, when the system calculates interest, the system will display a separate line. What is the total amount of loan outstanding, or what is the total amount of loan to be paid to bank as on that day, including interest. This I will show you, right, after calculation of interest. Then Here we have entered the calendar type, G. So what is this calendar type significance? Calendar type. The calendar type determines the number of days to be considered per period for which interest is calculated. There are 4 types of calendars available for the interest calculations in SAP. See, here, if you press on F4, right, you have the 4 types of calendars. B, bank calendar. J, Japanese calendar. F, French calendar. G, Gregorian calendar. So what is the impact of each of the calendars? Bank calendar, B. It uses 30 days as the basis for the month and 360 days as the basis for the year. Here itself you can see 30 divided by 360 means 30 days for the month, 360 days for the year. That means term loan amount. So we have taken one term loan. The amount is 1 lakh, right? Then rate of interest. Rate of interest, say 12%, right? Now, if you take the bank calendar, B, the system uses 30 days as the basis for the month and 360 days as the basis for the year. That means if you calculate interest for January, right? 1 lakh into 30 divided by, 1 lakh into 12 by 100. 12 by 100 means rate of interest, right? Into 30 divided by 360. Even though January actually contains 31 days, but the system takes 30 days only. And for the year, 360 days. Then, if you calculate interest for February, 1 lakh into 12 by 100 into same 30 by 360. Even though February actually contains 28 days or 29 days, the system takes 30 days and for the month and 360 days for the year. Then, if you calculate interest for April, again 1 lakh into 12 by 100 into 30 divided by 360 means for every month, system uniformly takes 30 days, irrespective of actual number of days. Then for the year, it takes 360 days. Then you have Japanese calendar, right? See, 30 divided by 365 means for the month, system takes 30 days, for the year, 365 days. As simple as that. Japanese calendar, J. I'm sorry. It uses 30 days as the basis for the month and 365 days as the basis for the year. See? Here, you have to assume that January is the example for the month containing 31 days. February is the example for the month containing, February month is the unique month, right? And April is the example for the month containing 30 days. It is not necessary to write all the 12 months, no? Then the case of Japanese calendar, January. 1 lakh into 12 by 100 into 30 divided by 365. February, 1 lakh into 12 by 100 into 30 divided by 365. It is 30. Then April, 1 lakh into 12 by 100 into 30 divided by 365. So the difference between bank calendar and Japanese calendar is only denominator. That's it. Then number 3, French calendar. See, 28, comma, dot, dot, comma, 31 divided by 360. That means the system will consider the actual number of days in a month as the basis for the month and 360 days as the basis for the year. See, French calendar. Yeah, Raghunandan. System takes the 28 days or 29 days, right? Based on the year, which is defined already in the system.
Okay, sir.
But in the case of bank calendar, Japanese calendar, whether there are 28 days or 29 days, it takes 30 days only.
Okay, sir.
Then Japanese calendar, it uses 30 days as the basis for the month and 365 days as the basis for the year. That means French calendar, yeah. January. If you calculate interest for January, system will calculate like this. 1 lakh into 12 by 100 into January actually contains 31 days, right? So 31 divided by 360. Then February. 1 lakh into 12 by 100 into 28 or 29 divided by 360. April. 1 lakh into 12 by 100 into, actually April contains 360 days, right? Sorry, April contains 30 days. So 30 days into 360. Then you have the fourth one, Gregorian calendar. Actually, the name of the calendar, what we use in our daily life, right, is called Gregorian calendar. So this calendar was invented by John F. Gregory. So on his name, it is represented as Gregorian calendar. Here, 28 dot comma, 28 comma dot comma 31 divided by 365 means the system will consider the actual number of days in a month as the basis for the month and 365 days as the basis for the year. See, Gregorian calendar. It uses the actual number of days in a month as the basis for the month and 365 days as the basis for the year. So, Gregorian calendar. See, January. 1 lakh into 12 by 100 into January actually contains 31 days, right? Into 31 divided by 365. February, 1 lakh into 12 by 100 into 28 divided by 365. Then April, 1 lakh into 12 by 100 into 30 divided by 360. So normally we use bank calendar. Banks also use the bank calendar. So to be on par with the bank calculations, we also use bank calendar. But in our training class, just like that, I have used, right? This is G calendar, nothing else. Click on save and enter. Write down the table name. P0 56 years. P0 56 years. Next, step number 3. Define reference interest rate. It is the identification for which we assign the real interest rate, that is 12%, 13%, etc. The reference rate of interest is assigned to the interest indicator. We can define any number of reference rates of interest. Right now, continue. Another point. The reference rates of interest. The reference rate of interest are defined at client level. The reference rates of interest are defined at a client level. Normally, for every actual rate of interest, we define one reference rate of interest. Means, for example, we have taken 10 term loans. Okay. So on 5 term loans, we are paying 12%. So for this, we define reference rate of interest. Then on 3 term loans, we are paying 12.5%. So again, for this 12.5%, we define another reference rate of interest. Then again, on remaining 2 term loans, we are paying 11.5%. So for this 11.5%, again, we define one reference rate of interest. Like that, for every actual rate of interest you pay to the bankers, right? We define one reference rate of interest. So at this point of time, we define the reference rate of interest. Later on, you can understand, probably in tomorrow's class, what is the impact of this reference rate of interest. Path is same as it. See, up to interest calculation global settings, path is same. Okay. After that, interest calculation. Define reference interest rates. Click on new entries. Reference rate of interest is equal to ST1, just like that. Reference rate of interest is equal to ST1. Long text is equal to 12%. Reference rate of interest. 12% reference rate of interest. Description. 12% reference interest rate. Date from 1/4/2024. Currency INR. Click on save. Now do one thing. Here again, write down. Click on next entry button. So let us define one more reference rate of interest for 11%. Click on next entry button. Reference rate of interest is equal to ST2. Reference rate of interest is equal to ST2. Long text is equal to 11%. Reference rate of interest. Description. Again, 11% reference rate of interest. Date from 1/4/2024. So this rate is applicable from 1/4/2024. Currency INR. Click on save. So like that, suppose if you want to define another reference rate of interest, click on next entry button, right? Write down the table name. T056R. T056R. Suppose if you want to define another reference rate of interest, click on next entry button. Give one identification. Again, define some other reference. Give some identification and fill up the other fields. That's it. Then define time dependent terms. This we will see tomorrow. It takes nearly more than half an hour. This you will see in tomorrow's class. So tomorrow, general ledger accounting will be over. Tomorrow we have the class at 6:30 p.m. IST as usual. Tomorrow, general ledger accounting will be over. Then from next week, we start accounts payable. Any questions from anybody? Okay, then see you tomorrow.